Intermarket technical analysis is not just some wacky concept that somebody dreamed up one day. There are some specific principles, and they're pretty constant throughout. What are some of the principles for folks who may not understand the concept?
Well, Ted, is basic economic analysis, except we're using the markets to tell us. We're doing the same thing that economists do. For example, we look at interest rates, which are a very important determinant in the stock market, for example. And we simply show that there's a very close link between the direction of commodity prices and interest rates. Obviously, the bond market, for example, is influenced by inflation. Commodity prices are an early indication of inflation. So whereas an economist might look at the CPI or employment cost to measure inflationary trends, we look at the commodity prices.
So in other words, you're saying no markets move in isolation and they're all...
That's exactly right. In fact, what we generally do is we divide the markets up into 4 different sectors. First of all, the stock market being the most important. Then we show that the bond market is influenced by the bond market. Bond and stock markets influence each other. The bond market is influenced by the commodity markets, and the commodity markets are influenced by the currency market. So those are the 4: stocks, bonds, commodities, and currencies. They all interact with each other, and the whole basis of intermarket analysis is that if you're going to understand what's happening in any one of those markets, you have to know what's going on in the other 3.
We're going to get into, by the way, looking at each of these relationships in a moment, but let's just continue with this broad overview. The basic relationship, stocks and bonds, what kind of trend? Do they generally travel together?
Absolutely. That is the key relationship. That generally speaking, if you go back and look over history, that stock prices do much better when the bond market is very strong. When the bond market runs into problems, and we're going to show some examples as we go along, that normally is a bad sign for the stock market. And the reason for that is that stocks don't like rising interest rates. Another one is the very close link between commodities and bonds. Generally speaking, commodity prices and treasury bond prices move in opposite directions. So when commodity prices start to move up, this normally causes problems for the bond market. And then the final link is the link between commodity prices and the U.S. dollar. Generally speaking, they also travel in opposite directions. So a rising dollar, for example, is anti-inflationary. It tends to push down commodity prices, partially because they're priced in dollars. However, when the dollar starts to weaken, this creates inflationary pressure. It pushes up the commodity
Don't tell the whole story here, John. Keep it right where it is. Maybe you want to get out a notebook. In just a moment, we're going to show you the specifics of the dollar versus commodities and that unique relationship.